All right, morning everyone. Thank you for coming to our Clear to Close series here. My name is Michael Bardalis. I am the mortgage director here for Radius Mortgage. And the Clear to Close series are different topics. And today I want to talk a little bit about loans for investors. What we're going to do today is go over like three specific products. Some of these products you may have heard of and know the name about it and things like that. But I also want to offer a strategy behind a product, right? Like, okay, now that we know that this is a loan for this, what kind of situation can we get ourselves into to bring us more business, but ultimately to build wealth, right? So being a real estate investor means you want to build wealth in real estate. There's really two ways of doing that, and we'll get into it. One is fixing and flipping, and the other one is buy and hold. So we'll talk a little bit about both products. Also, too, I definitely want to make this interactive. So if there's any questions you guys have, please let me know. I'll be able to chime you guys in and you can speak. Again, this is something that I don't want to be one-sided. If you have any questions about the strategies or the guidelines or things of that nature, this is the time to talk about it. All right. First and foremost, Radius Mortgage is a mortgage broker. That means we partner with different mortgage companies. Here are a few of our business partners. United Wholesale Mortgage is probably our top business partner. But on top of that, we have different lenders that offer us different types of things. So Sierra Pacific Mortgage, for example, that's the mortgage company we use for down payment assistance. When it comes to some of these strategies we'll talk about, the company we use is Newfi Lending. And again, when we talk about FHA, conventional loans, that's pretty much going to be United Wholesale Mortgage, Home Point, and PennyMac. These are our products. Again, there are about 4 different categories when it comes to loans. About a fifth one, if you're kind of like in banking. Banking has what's called portfolio loans. In this case, us being brokers, we pretty much have 4 different categories, right? So conventional, when you think of conventional, think of Fannie Mae and Freddie Mac. So products in there offer anywhere between 3 to 5% down. Also, we have a 10% down MI program. When government loans, think of FHA loans, 203B, 203K. Also think of VA loans as well. So we're approved with that. Jumbo loans, those are loans outside the Fannie Mae and FHA loan limits. So those are going to be something above like 0.2 in some counties. In other counties, it's a little bit less. But we also offer jumbo loans up to about $5 million. So if any of you in that luxury realm, we definitely have a product here for you guys too. Now, non-QM, this is where we're going to talk a lot about today. And these are different loans that qualify different people. So for example, someone has bank statements. Well, why is that a good product? Well, there's a lot of people that get what's called a side hustle. So they have their W-2 jobs, but they're door dashing. They may be having some sort of thing on Etsy, if that's the right platform's name. So they make an extra income in that realm. Sometimes with the conventional and the government loans, they won't accept that income. So we can prove that someone has a side hustle on top of their W-2. We can actually get them more purchase power as well. So that's what non-QM is about. Manufactured loan, I-10, and again, we'll go over some investor loans as well. For us as a company, processing and speed is the name of the game, especially for those that have buyers out there. It's a very competitive market. You're probably competing with a few different buyers, anywhere between 10, sometimes 30 buyers. And sometimes what takes you over the top is having no loan contingencies, but the other one is speed. So this is the kind of things that we are able to do here on our side at Radius Mortgage. We have some products that are 10 days clear to close. We have products that offer our clients 4 days clear to close. The cool thing about it is that you don't have to really close the transaction in this time period. What that basically means is that sorry about that, you guys. I have my coworkers getting upset at a UPS driver. But this is our process again. You know, if it takes longer to close a pre-approval, the loan process, that's totally fine. This basically means that our process is done. That means that the lending side of the transaction is completed, and now you can take as long as you need to close out the transaction. I think, as you guys know, sometimes the biggest stress of the file is not knowing if the loan is going to close. So to have that comfort within 4 days of the escrow or 10 days within escrow, I think will help a lot in your transactions. So talk to us about that as well. That is a little bit about our speed. Last thing before we get into the products, I want to just offer something that we're doing right now as a special. So far, it's going to be running to the end of March. I mean, to the end of April. I'm sorry, in the end of May. Got the month we're in. I apologize. What it is basically is that we're going to give borrowers 1% down. So long as they're putting 1% down, we'll give them 2% down up to $4,000. So think about it in that manner, right? You're getting an extra 2% down up to 4,000. That may not sound like a lot to most people, but in some cases, if we can take $4,000 and help them with their closing costs with a conventional rate. So think about the down payment assistance loans right now. They're typically about 1% higher than market rates. On top of that, they're 2% higher in fees. This product right here gives $4,000 with market rates and without an additional cost in fees. This is a grant through WM, and they saw that a lot of down payment assistance programs ran out of money. So this is their investment to give back to the homeowner. So again, even if it's just $4,000, they don't have to pay that back at all. 1 second. All right, so let's get into it, okay? Sorry about the little pause there. Again, we work from home at times, and my coworkers, again, are my two beautiful dogs, but at times I have to put them away a little bit better. All right, so let's go into this. So there's three loan products I want to talk about today. That's going to be your fix and flip loans. That's going to be your debt servicing cover ratio loans. And this is going to be a multifamily financing owner occupied, right? So these are three different strategies, right? In regards to fix and flip loans, those are short-term loans. So think about it in that mindset, right? We're not getting a 30-year fix here. You're going to get a 30-year amortized, meaning your payment may be 30 years amortized or interest only. But in regards to the loan itself, those are typically due back within 6 to 12 months of you getting that loan. Sometimes they're longer, sometimes they're 24 months, depending on the project. But again, these investors, these individuals that are giving what's called private money, or you may hear hard money, they definitely want their investment back within the 6 to 12 month range, okay? So we'll talk a little bit about a fix and flip loan. The next one is going to be what's called a debt servicing covered ratio loan. You're going to hear that sometimes as DSCR, right? That strategy in itself is a buy and hold. So for those that don't know what buy and hold is, basically it's literally what it says. You're buying a property and you're going to hold on to it. You hold on to it for a few different reasons, right? One, you're going to hold it for passive income. So knowing that you're going to get X amount of money after the mortgage is paid, and we'll get into that as well. Two, tax advantages, right? Great tax advantages to owning income property as well. And then number three, equity on the property, right? So if you're gaining X amount of money a month, let's say $1,000, that's $12,000 a year that you gain. On top of that, if you get equity growth at 5%, you get that gain as well. And then also the tax deductions too. So that's a great way of building wealth through DSCR loans. And last but not least is this multifamily financing owner occupied. So there is a way definitely to build wealth and to build passive income while living in the property, right? And that's going to be through buying a duplex, a triplex, or a fourplex. So we're going to talk a little bit about that. But again, that's another buy and hold strategy. The one thing about that one that adds a little bit different than the other three strategies is that it offers lifestyle. So not only are you gaining the tax advantage, the passive income through the rental income, the equity as well, but you're living there too. So from there, you get to raise your family, be there with your friends, so on and so forth. So it adds another fourth element when you're doing a multifamily financing owner occupied. Again, any questions, you guys, please chime in. We'll get into it right now. So what is a fix and flip loan, right? So some of this might be basic, and if it is, bear with me a little bit. I'm using super generic, sort of, I guess, cookie cutter type of situation here so you guys can understand exactly where it works. There might be other situations that are more experienced. The level that I'm coming in now is saying this is your first time investor, right? Like this is somebody who have some money and they want to do something in real estate, okay? From there, as they gain in experience with flipping homes, things get a lot cheaper. Requirements we get a lot cheaper as well. But in the meantime, let's just say, for instance, right now, that if you're going to go buy your first fix and flip, you're really going to need 20 to 30%. Okay. Definitely, I have friends out there that don't need a down payment whatsoever. They've proven their worth to their investors and they're willing to invest. But if you're taking the first person, it's 20 to 30% that you got to really think about to bring into the pot. Okay. The other thing is thinking about the repair value, right? So the repair cost in itself, typically, no matter what it is, how much you need or whatever the case may be, they're only going to give you about 60% of the future loan to value of the property, including the acquisition costs. Again, I'll break all this down in the next slide, but just understand that. So it's 60 to 70%. So from there, I'll show you an example of what that means as well. Couple of these different loan terms. They're going to be about 1 to 3 year loan terms, interest only. So again, 1 year is pretty much when they want their money back. If it is a 3-year project, it's probably because it's a new construction from the ground up, so on and so forth. A lot of these people here probably want it done quicker, but at the same time, always think about a year. Like think about it in that mindset. And when you think about this as well, and something I probably didn't put in here, it's going to be holding costs, right? So we can get into that as well. But the moment you close a property, for example, and you're in escrow, you got a 1 year loan, but also you have a 1 year full of payments. Okay. So on top of doing, taking into consideration fees, down payment, you also need to take into consideration carrying costs as well. So again, to these, they're 1 to 3 year loans, repair funds. So the money that is given to you to build the property, keep in mind, those come out in phases, right? It's not like a cash out refinance. It's not like the moment they agree to give you $100,000, you're going to the bank the next day with the check. Again, if you're an experienced investor, you have made money for these individuals, it may be a lot different. But typically, when you're first starting off, they're going to have you do it in phases, right? So when you reach to this dollar amount, so let's just give an example on that. I will release $50,000 of that. So whatever you're going to do, make sure it's under the $50,000 threshold, right? So from there, that might include permits, that might include drawings, whatever the case may be. You bring it to that level. Once you get to that stage, you prove them that, then they'll release an excess set of money. That's typically how it's done with funds. But again, the more experience, the more you'll get your money more upfront. They're going to be the highest interest rates in the market. A lot of people are like, well, where are the rates at? It's not like that, you guys. It's literally dependent on credit. Like the one thing I would say about investment loans, and I don't want to push people away that don't have bad credit or whatever, but in the beginning, your credit is going to be super, super vital. So having the most stellar credit is going to give you like the lowest possible rates. And even with the lowest possible rates, those are going to be still the highest rates in the market, okay? So sometimes think double digits. I'm definitely not going to quote rates here at all, but just think sometimes high, close to double digits or double digits loans for that. In regards to fees, they're going to be about 2 to 5% higher, right? So again, when you go to FHA loans, conventional loans, those are typically about 3% of the purchase price. The reason being, there's no origination charge, there's no broker charge, there's no charge in regards to that, right? However, with these loans, they may come with a 2% to a 5% charge, again, depending on your level. If you're going to be a first-time person, more than likely your fees are going to be closer to 5% because, again, they're giving you something and going on faith. But if you're a seasoned veteran, then you'll get down to the 2% level or even down to something lower than that as well. So again, that's sort of like the terms and the products of a fix and flip loan. Again, if you're going to buy the property, 20 to 30% down. If you're going to need money, meaning construction costs, you're probably going to get about 60 to 70% of the future value. And these are the different types of loan terms that we have here. Go to the next slide. So I wrote up these numbers here to kind of break down, okay, like what does it look like, right? What does it mean if I'm going 70% loan to value? What does it mean in regards to that? So let's take a scenario here. Let's take $1 million, for example, right? For some of you, definitely there's opportunity for such a lower purchase price in your areas. For me, I'm in the Bay Area, so let's just kind of go with these numbers a little bit here. And plus, working with $1 million is a lot easier to calculate than going a little bit lower. So acquisition costs, we're going to go 70% loan to value. That means in this case, the individual is going to need about $300,000 down payment. Before we go on to the next step, a lot of individuals may say, hey, I don't know how I'm going to get this $300,000. I want to do a class later, and kind of reminded me last week about it when I was talking to Joanna about these kind of like these private REITs where you can bring people around you, family, friends, or whatnot, and create a fund. And in that fund, you guys can bring investments, right? So this 300,000 never needs to be on one individual. It can be on a party of a couple other people as well. When you take 401k into consideration and stocks into consideration, like think about what maybe someone has $10,000 laying around in their savings account. As long as you guys put something together, get an attorney involved, there's some really power in behind creating sort of your own fund to do these strategies as well. But let's just say, for example, one person has a 300K, their mortgage is going to be about 700,000. Okay. But they've noticed that after the repair value, right? So their ARV after repair value is going to be about $2.5 million. Okay. So what that means, if you go 60% loan to value, the max loan that they're going to allow you to do on this property is going to be $1.5 million, right? However, you already have a first mortgage, right? So they're not going to give you just the 1.5 to construct because you already are in debt for the first mortgage. So you take the first mortgage of 700,000 minus that from the total of 1.5, and that's where you'll have 800,000 available for funds for repair. Now, again, that 800,000 doesn't come as a lottery ticket. For some people, it might. They may get the funds the next day, so on and so forth. How do they come to the after repair value? That's probably a question that a lot of people have. It's going to be by probably the investor's appraiser, right? It's not going to be by your appraiser. It's not going to be by your construction people. They're not going to take what you think this after repair value is into consideration, again, unless you have the experience. What they're going to do is they're going to send out their own people to kind of figure out what it is. It's going to be proven by comps. It's going to be proven by them. But from there, the after repair value is going to be always determined by the person giving you your money. So again, when you do that and you take this into consideration and you're selling this, $2.5 million home, just know that you're already in debt $1.5 million, right? Also, you got to take in consideration the carrying cost for that, right? So you multiply your monthly payment times that by 12 months, add this into the mix as well. And then you're going to take your seller net sheet, add this into the mix, and then those two totals plus what you see here minus the 2.5 is going to be your total gross net. So hopefully I didn't go too fast in regards to that. But again, if you guys need a copy of these slides, if you have any questions right now, please let me know. But again, this is super cookie cutter flip scenario, basically how it works. In regards to these things, like I mentioned before, just think of loan to value at 70% for acquisition cost. So when you talk to individuals and they approach you about, hey, I want to do a fix and flip loan, and can you help me with that? Like, yeah, definitely. I have a lender, Michael, that can help you with the fix and flip loan, but have you saved up for a down payment? Are you using that? One of the great strategies right now that you can use this on is going to be your home buyers that you had 3 to 5 years ago. If you think about the market then compared to where it's now, a lot of them have gained a lot of great equity. So that equity there is just kind of sitting, right? So it's just sitting there, which is great. And, but in regards to owning a property after your 5th or 7th year, you should utilize the equity in there to buy a second property, right? Once you start building your second property, your 7th year, it could be a buy and hold strategy. It could be a fix and flip. But, you got to think of money as kind of like sitting there. It's not really doing much. You need to have money working for you in regards to that. So taking out some money on a HELOC or a HELoan or putting some funds together, those are your clientele for fix and flip. All right, I'll move on to the next one. So this is a pretty popular one. It's kind of been around a while, but like within the last couple of years, it really has been coming out. And that's a debt servicing covered ratio loan. Basically what this is an investment property mortgage that borrowers qualify for based on the cash flow of the rental property. So what that's saying is that there's a property here, and let's just use a triplex, for example. And each of those units is occupied by a tenant. And that tenant is paying, let's say, $3,000 in the first unit, $2,700 in the second unit, $3,000 in the third unit, right? So roughly they're paying about $8,700 a month in rents. What the lender is going to do is that they're going to take that into consideration of income. They're going to sit there and take that $8,700 and consider that an income on top of the income that you make as well. Or they're just going to say, guess what? This actually covers what the mortgage payment is. I don't care how much you make. I care about how much you're going to put down. So that's what the debt servicing coverage ratio is about. Minimal FICO here is going to be 680 minimal FICO, 75% max LTV and CLTV as well. There's no mortgage late. So again, you can't have any mortgage late in regards to getting this type of loan. And obviously you're going to need at least 36 months of seasoning on any credit event, right? We want 3 trade lines, so think about it in that way. So we want to see at least 3 types of trade lines at the 36-month mark. And this is going to, again, be for those that aren't experienced investors, right? If you are an investor, then here, this is where we find an experienced investor is an individual who owns at least one commercial or residential investment property in the United States for 12 months in the last 3 years, okay? So we can't consider your own home, obviously, even though you own it and you are a home owner, but that's not what's considered a real estate investor, okay? The products that I mentioned here below, the 680 FICO, 75%, those are going to be for inexperienced individuals. When you are and you have reached this threshold of owning a commercial property or residential investment property, again, the guidelines change, the requirements change, but I just kind of want to go over that a little bit to understand like where that comes from. So let's take in consideration here what a DSCR scenario can be for a triplex, okay? So again, we're going with 70% loan to value. I'm still using my $1 million acquisition, okay? So again, all these numbers that I'm going to present to you guys today is going to be $1 million. So I did some rates, and if you guys want to do our rates, kind of want to break down a DSCR loan and what it looks like here. So as you see here, when you do a DSCR loan, you have about 8 different types of loan you can get within there. You can get a 30-year fix, a 40-year fix, a 30-year O, a 5/6 ARM, so on and so forth. So this is what we call our real estate matrix. So for every product a lender has, they have what's called a metrics, right? Matrix or metrics, sorry, depending on when I say it would be the proper word. But in regards to this is everything we need to fit our borrower into, right? And all the different options that we have for them in their regard. The loan amounts, the interest only considerations, prepayment penalties, all the stuff about the DSCR. This is where we get our guidelines for the maximum loan amounts that they do, the reserves that they need, the FICO scores that they need, so on and so forth. So we take all this stuff into consideration, and then we run our rate sheets here. Again, we do have a portal that runs this, but I thought it would be nice to kind of show you guys our background here. So we go here to DSCR loans. Again, all the different rates here, depending on what's charged, depends on what rate is, depending on loan to value, depending on FICO score, we take that into consideration. Once we take all these 3 buckets into consideration, that's when we come up with your interest rate, okay? The reason I showed you that, oh, I didn't get to show you that, I apologize. There we go. So this is our rate sheet. This is where we take into consideration a lot of the stuff that I just mentioned. This is what it looks like, and it's all fun stuff. So in this case, I priced out a loan, and the pricing that I got for this loan is a 9.5% interest only, 7-year ARM with a 1.74% DSCR rate, okay? What we did here is we took the $1 million consideration of acquisition. We did a $300,000 down payment and a $700,000 first mortgage. The yearly taxes are going to be $11,250, and the homeowner insurance is going to be $1,200. So when we break down this mortgage, the mortgage payment comes out to $5,541. The property taxes are $938, and the insurance is $100. However, when we look at our rental income, we see that unit 1 is $3,500, unit 2 is $3,250, and unit 3 is $2,850. And again, you guys, I am using Bay Area rents. You'd be surprised what a 1-bedroom, 1-bath would get you here. I took in consideration 3.2 for the first unit, 2.2 for the second unit, and pretty much another 2. I took in consideration square feet as well. So that to me where I came up with the rents. Another rule of thumb that I use as well that might be helpful when you're looking at rents is using a website called Rental Meter. Literally, you can put in a property address, the market it's in, so on and so forth, and it'll spit out the lowest, the medium, and the highest rent. So that's something to use as well. So as you see here, the total monthly rent in this property is $9,600, with a mortgage payment of $6,579, shows them a monthly cash flow of $3,021. So you see here, this is a great scenario where someone just put down their down payment, but they're not paying anything out of the pocket. They actually don't need to qualify on their own income, because with the rents that they're getting versus the mortgage that is given, it actually covers for the DSCR loan. So this is a great example of what to do to not include that. So these are great for those that are, self-employed. These are great for those that are bank statement people, but it's good for anyone, to be totally honest with you. So long, again, as a debt is servicing the covered ratios and it's servicing this mortgage, you can definitely get more property. Why is that a big deal? The reason it's a big deal because majority loans are heavy on debt to income ratio. I've denied people that had literally, I'm not even lying, $1 million in their bank account, 850 FICO score, but they didn't have a job the way the lender wants them to have a job. They couldn't get anything. They couldn't get a loan for nothing. So in this case, those are these individuals that they're maxed out at their DTI. They cannot buy another property through Fannie Mae, through FHA, whatever the case may be. This is a way to do that and be able to work money. Again, great strategy, debt servicing cover ratio. I love it a lot. It works a lot better when it comes to more triplexes and fourplexes. You could find a few good strategies with duplexes, but I think you're going to maximize this loan when you have extra units as well. So I encourage, looking into that with triplexes and fourplexes. Again, if you're going after individuals for this type of products, what I would do is scour the world first. So look at your market, look what triplexes are available, look what duplexes are available, see where it's at. Triplexes are kind of hard to find, especially in residential neighborhoods. But if you go to the more urban areas, you'll find a lot of those type of places in regards to triplexes and fourplexes. Cool. Now let's talk about a cool strategy here, just using FHA and conventional. I just chose FHA for this scenario because conventional is almost the same exact way, but in this regard, I'm using FHA. So think about it in this manner. I'm going to show you a strategy here that you can buy a property using FHA, and what that means is only 3.5% down. Again, the strategies I showed you before were 30% down, right? Not a lot of people have 30% down. However, those strategies were for individuals that also owned a home already, right? So a lot of these people there own the home and now they're buying something else. They're using their equity, reason why they have 30% down. But how can we take a homeowner today and get them some instant equity, so on and so forth, and put them in a rental situation? And that's going to be through an FHA multifamily situation. So here, again, using the loan limits in the Bay Area, these are the different loan limits. So for duplex, it's about 1.4 million, 1.394775. That means your max purchase price for a duplex would be 1.435. Triplex, 1.685, 850. Or max purchase price there is going to be 1.725. Fourplex, the max loan is at $2,095,000, and the max purchase price is going to be $2.175 million. So you see here, great opportunity, right? They're acknowledging that when you buy these properties, they're going to probably be a little higher than the other individual properties in that area. Reason why they're going higher on loan limits. But think about it in that manner. You still only have to come only 3.5% to buy properties in this area. So let's come up with a acquisition cost. Let's come up with a scenario here. Again, keeping with the $1 million. What we're going to do is we're going to put 3.5% down. Look at that. That's only $35,000, right? So you're going to get a mortgage of $965,000. Again, we're going to take the yearly taxes into consideration. We're going to take the homeowner's insurance into consideration as well. The difference that you're going to see here in regards to this is that, one, you're going to have private mortgage insurance, right? The other strategies with the 70% down didn't have private mortgage insurance. In regards to FHA and in regards to any product, anything less than 20% down will include private mortgage insurance. So in regards to that, we take that into consideration, $599. We take the property taxes on a monthly basis into consideration at $938, and the insurance at $100. We take the mortgage payment of $5,714. That gives us a monthly total of $7,351 here. Okay. So as we see here, the monthly rents that they can get here is going to be $3,500 for the first, $3,250, $2,850 for the third unit. That's total rents of $9,600. Now remember, they're probably going to live in the biggest unit there, right? So in this case, what we're going to do is, although we can know that's the rent we're going to get, we're going to deduct that from the $9,600, right? So in this case, it's $3,500. So now that total is 6,100. So $7,351 minus 6,100. This individual is only paying $1,250 in their property, and that's huge. Although it's not giving them their monthly cash flow as it shows here in regards to getting all the rents, it is showing that they're living in $1 million property at only $1,200 a month. As you see here, the monthly payment would be $7,351. Sorry about that. Would be $7,351. But they're able to qualify on this loan due to the fact that they can use the rental income and use that rental income towards the debt for their debt service. And in regards to that, only pay $1,251. In this case, this individual again is building lifestyle, meaning like I live in a house and I'm only paying $1,250 to live in it. Two, I'm building equity. Because of the equity, I'm being able to buy another property, so on and so forth. Three, taxes in regards to depreciation, in regards to the rental income as well. And then four, eventually the rents go up. So when rents go up, that money will actually shorten. And then at one time or another, they may be paying nothing to live into that property as well. So I think this is a great, again, situation. Again, duplexes may cut the mortgage in half for you. Don't get me wrong. And that's a good situation right there. But when you're getting into these triplexes, when you get into these fourplexes, that's where the money really starts coming in. That extra unit, does a lot different, right? So if you think about it in this way, this was a 2-unit building, you'd probably have only rent income of $3,200. But in this case, you almost double your rental income by having an extra unit. The other strategy that I mentioned too is a fourplex. I think fourplex are really good too. 2 homes on one lot, that's another property that you can see, especially in an owner-occupied situation. The one thing about owning this property and being owner occupied is that you have to have a mindset of like kind of not allowing your tenants to just be having a great lifestyle without feeling they're being watched upon, right? So that's always the one thing, knowing that, you may come home sometimes to a different situation with your tenants, but you got to have that mindset as well. Some people are able to do it and balance it super well, where they're super cool with their tenants and everything is kosher. Sometimes most people don't want that. So we got to really depend on this strategy, knowing that this is going to build you wealth. This is going to build tax strategies, but it's also the place where you live. So if you can deal with that, this is a great strategy in regards to it. All right. Love to hear any feedback. I also want to show you guys before we get into it is a couple different books here that really can help you out in regards to, I think, some strategies or whatnot. These books have been out for a while, so it's nothing that I'm sharing with you guys that you guys probably didn't hear. But the one thing about all of these strategies, you guys, is you got to think of real estate math, right? Like when I first got into the game, I really learned a lot about real estate math, price per square feet, acquisition cost, after repair value, those type of situations, right? If you think about real estate as a whole, the math is really just adding, dividing, multiple, divisions, fractions, decimal points, kind of like arithmetic, right? Things we learned kind of like in elementary. The cool thing about it is that we have a calculator now. So a lot of this stuff can be inputted and given us this. Excel spreadsheets as well is really good. The reason I mentioned the Millionaire Real Estate Investor is that, they break down a lot of different strategies in here. And this is a good way to learn real estate math, right? So I think to be an investor, even those that you're talking to, encourage them to like understand that part, understand calculations, understand that those deals. The other thing I would say about real estate investing is that anyone can always get into a strategy, but you make money when you exit that strategy, right? So with buy and holds, think about it. You're getting some monthly income, that's great, but the great amount of money is going to be when you sell that property, right? That's when you're going to gain it. Same things in any strategy is being able to get out of that. Is that when that's when you're going to make your money. Since we talked about rentals, this is another great book by Mark Ferguson. This is Build a Rental Property Empire. I really suggest this book being a must read as well. Buy and holds. I'll tell you one thing. My mother-in-law, when she first came to the United States here, I think in the early '80s, she bought 4 rental properties. To this day, she has 3 of them, and to this day has great passive income for her. She actually retired in the time when the market really went down in 2007 and 9, where a lot of people had to go back to work, but she was able to not go back to work based on the rental income, right? She's able to put her daughters through college, able to build an empire. She bought properties by refinancing and taking cash out on these rental incomes. So in regards to that, it really can help people's lifestyles, put kids through college, buy you that extra house, and also, make sure that you don't have to go back to work when the market crashes as well. Awesome, you guys. I really appreciate you sticking around, listening to me. If anything was unclear at any time, reach out to me. I am available. Message me here on this platform if you don't have my information. But anything you need in regards to financing, we definitely have your back in regards to it. Next strategy I'll come up with will be not something else. I kind of like going over these loan strategies and how to actually use them in the real world. I think it would be super important. So you guys have a great day. But before I chime out, is there any questions? Anyone have anything to ask or to give feedback on in regards to what we went over? Cool, you guys. All right. Well, have a blessed day. Happy 420. Peace, love, and real estate. And we'll talk soon. Bye.